So let's wrap up with health plan alternatives. So sometimes when you're looking at your plans right now, and from a health plan standpoint, you're standing out there and there's a maze, and you're not sure where to turn. You're in an insured program, and you're not sure what step to take next. And I think this illustration, there is some rays of hope at the end of the tunnel, or there's lights of hope out there. And the two things that we're going to talk about today in the last 20 minutes is defined contribution plans, go over a little bit more about what they are, how they work, the pros and the cons, talk a little bit about what's new, and then also talk about captive risk programs. And these are two new things. The defined contribution has actually been around for a long time, but I think it's something that you're going to be hearing more and more about. You're also going to hear the word private exchanges, and that's going to be a new buzzword that's coming out. And then these new captive risk solutions is going to be something that we see as the marketplace continues to evolve, a big and changing dynamic out there. So with defined contribution, I put this picture up here because a lot of people are going to think defined contribution is brand new. And like I said, it's actually been around for over 20 years. So it's not a new concept, but there are a lot of things that are driving the conversation. So why defined contribution now? ACA. It's amazing how the ACA touches everything. One of the things that hasn't been launched successfully yet, either on a national basis or in the state in Oregon or Washington, is the SHOP program. That's the small employer health options. But what it is being touted as choice for employees. So there was, again, if Cover Oregon was working fully, you could be a small employer, you could send your people to the exchange, and they could choose from 7 different carriers in 4 different plans. They could have 28 options to choose from. So again, that choice is becoming a bigger and bigger conversation. Then I also think the employer mandate, the individual mandate, that is driving the conversation. Historically, if you had people opt off of the plan, that was a good thing because again, it was saving you money. They might have been covered under a spouse's plan or whatever the option was. They were not being covered under your plan. But now we're seeing a lot more employees sign up for employer plans that were opting out. And so the employers are seeing their budgets go up. And what are some of the ways to control that? We also see technology. And again, it's amazing how quickly technology changes, but there are brand new enrollment platforms out there that are making these choice options or these defined contributions much more doable. Payroll systems. You're seeing ADP and several other payroll vendors out there create their own systems as well for enrollment of benefits. And then you're going to see even carrier options out there where carriers are going to now offer you on a medical choice, and they can do it right now, but it's more paper-based. But in the future, you're going to have a carrier that says, if you want 3 or 4 plan designs, you can have 3 or 4 plan designs, and we're going to have an online enrollment system that you can tap into. So it's easier for employees to make choices. And I think ultimately, what we're seeing out there is we do live with a diverse workforce. Think about how many people that you have in the 55-plus range, and then how many people do you have in the 25 to 34 age range. Very diverse populations, very different needs. And again, giving those people the choice, so if they only have one medical plan, that may be great for a certain segment of your population, but other groups it may not be a best fit in. So again, giving those, creating some consumerism, creating some choice for employees. And so what is defined contribution? Really, you've probably heard the word cafeteria plan. And again, it's been around for a long time, but basically what employers do is they give employees a flat dollar amount each month, and they spend it as they see fit on that cafeteria or that menu of items. The pros, it is something a lot of employers, it's very easy for an employer to budget. If you're going to say I have 100 employees and I'm going to give each employee $500 a month, you can do the math pretty quickly there. What employers really like is the fact that their rate increase is now decoupled from medical inflation. So if you're giving a $500 a month contribution and you budget a 5% increase to that $500, that's your increase on your medical plan, let's say, or your benefits package. Again, if the health plan goes up 12%, that's something that the employees are going to have to make choices on, but it really decouples medical inflation from what the employer's budget is. And then the last thing, typically employees have more choices. So again, you may see that decoupling, but you are going to typically offer 2 or 3 different options for employees to choose from for a medical plan, for a dental plan, and then all the voluntary programs as well. Of course, the pros sound good sometimes. simple to budget, decoupled from inflation, but there are some cons to the program as well. You must offer a cash out option. So if you offer that $500 contribution and they want to waive off of all benefits because they can legally, the carriers will allow them to do it, you must offer a cash out option. But again, you don't have to give 100% of that. You can go 25 cents on the dollar. So if you have a $500 contribution and you want to give a 25% opt-out, you can give them $125 cash. They have to pay taxes on it, but that can be netted to their take-home pay. The other one that's a big challenge, depending on how your current contribution is set up, that can be a challenge in moving to a defined contribution. So for example, a lot of employers we work with contribute, let's say 70, 80, 90, 100% of the employee-only premium, but they don't contribute anything to the dependent premium. In those situations, it's easier to transition to a defined contribution because in essence, you're giving everybody kind of the same amount right now. Where it's a challenge is that if you have a larger contribution towards dependents, so you may pay 90% of an employee only, but you may pay 60% of the entire family premium. So that employee contribution, you might be giving them $400 a month, but if they have their family, you're giving them $800 a month. In a defined contribution, everybody gets the same amount. So again, those employee only, they're going to see their contribution go up, so there's going to be a winner. But that family, because you're equalizing everything to an equal number across the board, that family contribution is probably going to go down, and you're going to have some dissatisfied individuals in that family or the employee and child category. So it does present some challenges. I think the last thing that people need to think about, though, if you're looking at any private exchange, defined contribution, anytime you offer choice to employees, it does add to the complexity. So just stop for a second right now and think about how well do your employees understand the health plans and the benefits that you offer right now. And think about how they struggle about different deductibles, co-insurance, co-pays. Again, it is a complicated system, and it may be that you only offer one plan and they have challenges. Janet, I see you smiling, so I know we just talked about this. So anytime you start to add more options, it does become much more complex. So I think it's something as you move forward, having those 28 options, whole bunch of different carriers, whole bunch of different plan designs sounds great from a choice standpoint, but just think about your typical employee. If you put 28 options in front of them, how do you think they would respond? And again, you don't have to answer me on that, but again, it would be a challenge. A lot of them are going to be in your office saying, hey, I don't understand this. What are the options? What does this mean? What does that mean? So there's some challenges out there as well. So what's new? So defined contribution's been around for a long time, but what is new? You are going to hear that word private exchanges. So this is an evolving marketplace. You're now going to start to see multiple carriers and or multiple plans offered for both medical and dental to employees. And so this is going to be something that is going to be evolving out there. So you could hypothetically have a LifeWise plan, which is a PPO plan, next to a Kaiser plan. And now people have options with multiple programs. Or a PPO dental with a Willamette dental and maybe a Kaiser dental as well, and having people have choices between those plans all on one system. And again, there's going to be a ton of voluntary options. You have the traditional voluntary options, your life insurance, your short-term disability, those type of programs, but you're going to be seeing the evolution of new products out there. We're seeing a lot more gap plans. So again, deductibles, out-of-pocket maximums have gone up. We're seeing employers on a voluntary basis add these gap plans, and these gap plans basically backfill for a portion of the deductible or a portion of the coinsurance, and it's something that an individual employee can make a selection on and say, I'm going to sign up for that because that's a good fit for my family or my personal situation. And then enrollment platforms, and this is probably the key evolution. There are now systems out there in the marketplace, whether it's through a standalone company or a payroll or an HRIS vendor, that's allowing you to be able to offer multiple plans and again, still be able to administer it. I mean, just think about the complexity if you have multiple carriers, multiple plan designs, how do you even keep track of what employees are enrolling in? But what we're going to see is there are, I think I counted up the other day, 120 different options in the marketplace as far as standalone enrollment options. So basically they're going to be carrier agnostic, so regardless of what medical and dental plan you have or the life or disability carrier, they're going to be there for you and you can plug and play those carriers into those plans. Again, we're going to see a lot of integrated payroll systems coming out with online enrollment. ADP already has it, UltiPro, several of the large ones already have it. We're starting to see the affordability of those plans start to come down, and coming down into the mid-marketplace, so under 1,000 lives, and making it more affordable. And going to be two avenues there. One's going to be self-serve, which is kind of the ultimate, where employees can go on, they can do all their enrollment, they can make changes to their beneficiary forms, their eligibility, do everything online. That sounds great, but again, it's complex depending on your workforce. That may or may not be a great fit. We're also seeing some employers say, we want to have the online enrollment system because we only want to add the data or enter the data once and then have the system send it out to the multiple carriers. So that is an option out there, and so we're still seeing some HR controlled using the old form of paperwork or some type of enrollment form, doing the data entry, but then streamlining it out to all the different carriers. So you're seeing a lot of changes out there. Consolidated billing is going to be part of almost every package. So you may have 5 different insurance carriers that you're dealing with: medical, dental, life, disability, voluntary. But again, consolidating them all together so you only have to write 1 check a month. And then again, those monies are dispersed to the appropriate carriers by that vendor. And then the last thing that is going to evolve, and obviously as you add more options, you're going to need to have more decision support and more education. And there's some pretty amazing tools that are coming out and evolving to where it can help employees and their families navigate the choices. And so that is evolving as well. A lot of education still needs to occur in the marketplace. And I'm just going to flip through these real quickly. This is actually a sample of an enrollment platform, one option. You can see that it's personalized to the individual. So this is an individual that's logged in. And then this is an example. This individual actually has, and I know it's a little bit blurry, but they actually have 4 different medical plans that they can choose from. So a little bit more on the complicated side, but again, it shows you that, again, all one thought, one page, you can do the enrollment. This is also for additional term life. So you can see down there that they can select a 1X, 2X, 3X. So whatever benefit structure you have, you can program that in. What you'll also see on the left-hand slide or side of the slide is the check marks. So this individual has already done their medical enrollment, their dental enrollment, their vision, their FSA plan, healthcare, dependent daycare. Now they're moving into the voluntary life. So again, you can walk them through each benefit line that you offer, make sure that they've checked the box, that they've moved through that, and again, it's all wrapped up. And then what's nice at the end, you get a confirmation. So this is a summary of everything that this individual is enrolled in, their medical, their dental, the vision, what the payroll deduction would be on a pre-tax and also on a post-tax basis. And this is actually something that the individual could print out for their records. And it's great documentation that they've done this. It's now in the system. It will push out to the different vendors. So it's very, very streamlined. So just wanted to show you a little bit of what's out there. And each group is different. Each group is unique. But there's a lot of options and a lot of opportunities. So with regards to defined contribution, the private exchange, our response, we are building right now a private exchange. So we are looking to launch that 7/1. It's going to be called the Partners Marketplace. And we are looking at having multiple plans with a single carrier and also multiple carrier options. What we're trying to do, though, is to keep it more simplified. So ideally, for that choice of that employee, they may have one PPO plan and one HMO plan. So trying to make that choice pretty clear-cut and pretty simple versus offering the world to them. Again, things will evolve over time, but like we had on the wellness side, we're looking to crawl, walk, and then ultimately run. And it will have all benefit-related programs: the medical, the dental, the life, the disability, voluntary, including flex spending, etc. At the end of the day, though, it's a great system, it's a great tool, but you still need to make sure that you're doing what's best for you and your employees. So you still need to have that full market survey, doing the full benefit consulting to make sure you are finding the best carriers to fit in there. Because there's going to be some platforms out there that just say you can get the platform, but we only have one carrier as an option. So again, there are going to be some limitations as things begin. But again, the marketplace is evolving. It's amazing the new technology that is coming out. Carriers are coming out with new options as well as the different vendors. We're seeing more and more payroll vendors add this as a solution and really bringing the cost down to a point where it's actually very, very affordable for even mid-sized employers under 1,000 lives. So again, wanted to share that with you. And then the last thing I wanted to wrap up, we got about 10 minutes left here. I want to talk to you and introduce a new concept called captives. So again, this is going to be another word. You're going to hear a lot about defined contribution, private exchanges. Also want to share with you this word of captives. And sometimes when you're looking at that benefit decision and not sure which way you want to go, you actually just want to burn down the maze and go a completely different direction. And so that's what we're looking at here. And so what's driving the demand? This captives is really going to be for those insured programs out there, those insured employers that are frustrated with the insured marketplace. And so again, dealing with carrier changes, plan design changes, year-over-year increases, and really there's not a good feel for, okay, what are we really spending, the transparency, what are the true costs of the plan, what are we paying for, we're in this large pool, if we do wellness, does it really have a positive impact? All those different things, those are questions out there. So people are looking to escape the fully insured marketplace. Healthcare reform fees. Now we can't escape all of them with a captive, but there are certain fees and state taxes that you can avoid if you move into a captive arrangement. So there's additional advantages there. Also, you typically find in a captive solution, you're eliminating the carrier margin, you're lowering the admin cost or the load to administer the plan as well. So there's cost advantages there. And then really the last thing, and actually I think we got two there, a lot of the employers that are going to be a candidate for captive is that you've had very good experience historically. So, sometimes we think about if I get a no rate change, that's a home run and I'm really excited about it. You may be actually a perfect candidate then for a captive arrangement because you are probably then subsidizing other employers in that risk pool, in that fully insured pool. And so that is something where you're looking to get out of that pool, stand on your own, but depending on your size, it might be a little bit scary because really what we're talking about here is moving to a self-funded platform. Again, it's a way to control risk though with the captive, but again, we'll talk more about what does it really mean when we talk self-funded. I put up there in parentheses the word bundled plan. There's a lot of different acronyms out there, but basically this is a package, but you are self-funded. And this is something you can do through a captive. Actually, LifeWise has a great bundled, self-funded program as well. So there are multiple options in the marketplace. But just to give you a little bit of breakdown for those of you that haven't looked at self-funding before, basically you're breaking apart the pieces and then bundling them back together. So you're still going to have a third-party administrator. That's going to be the entity that's going to pay the claims. They're going to administer the plan. You're still going to need to have a network. So when you go see a doctor or provider, when you go into the hospital, you're not going to want to pay billed charges. You're going to want to pay discounted charges. So you're going to have a network. You're also going to want to have a pharmacy benefit manager. That's the people that are getting you discounts on the prescription drugs. But again, that's all bundled together. The key with this program is how the stop loss is arranged. So typically in a captive situation, these employers can come in and enter at a much lower or buy a much lower what's called specific stop loss. And specific stop loss is basically the maximum risk that an employer takes per covered live under the plan. So we have, I was working with a group a couple days ago, there are about 150 lives, they're self-funded, and their risk is $60,000. So they have a $60,000 specific. So the first $60,000 of any claim in a calendar year, they pay out of their own pocket, then the rest is ceded to the reinsurance carrier. For some groups that are taking that first step into self-funding, that may be too big a risk that they want to take. So what we can do in a captive is you can actually buy down the specific, and in this example, we've ran specific from $25,000 to $75,000, and that's again the employer risk per person. We actually have one option out there where you can get the specific down to $10,000 as well. So you can really, as an employer, control your risk on a large claim. Then where the captive comes into play is the second layer. So you have your specific up to 25 grand. Then this, the reinsurance, the captive, takes the risk from, let's say, 25,000 up to 250,000. So that is what you are participating with other like employers. So if you have a claim that goes to 50,000, you pay the first 25. The captive then picks up the next 25,000. Now, ideally, though, we're not going to have all those large claims. And then the last bullet there says, reinsurance over 250K. Any of these large claims, you want to cede to a reinsurance carrier. So the captive as a whole buys protection that if you do have a large claim, First 25 is your responsibility. The next 225 would be the captive's responsibility. Anything above 250 is ceded to a reinsurance carrier. The largest claim I've ever seen in one calendar year in my 20+ years has been 1.7 million. So those large claims do occur, they do happen out there. So it is something you need to have that upper end protection. But ideally, because you're coming together, you're like-minded employers where you're focused on it's good risk, you're focused on wellness, improving the health of the people, the risk in this captive is a very good pooled risk. So ideally that captive, if you have surplus at the end of the year, the captive can actually distribute reserves back to the members, or those dollars can stay in the captive to build up a reserve to take future claims. So it's a great option to come into a plan, lower risk for an employer, and then again, there is some cost sharing with those captive dollars as well. So who's a captive candidate? Ideally, you're an employer between 75 and 300 lives. You want to have a stable workforce, good demographics, so obviously that means a younger age, ideally more males than females, but again, a good mix in there. Strategic long-term buyer. Really what that means is that if anybody is considering moving into a captive or going into a self-funded arrangement, it's not something that you just try out for a year. This is a commitment, this is something you need to be going into to saying, we're really going to move down this path because there's other things other than just purely cost savings that I'm looking for. Transparency, access to claims data, more predictive modeling. So again, you're fully insured and frustrated with the lack of control, historically good stable claims, experience and rates. And then the last thing is the employers that get into the captive are really going to be focused on risk management. So again, a lot of the plans that we're looking at in these captives are going to have the engage strategy that Elisa just talked about. So again, you couple those together with, it's a good performing group of individuals, but then we add the wellness component on top to make sure that we're controlling the risk on a go-forward basis as well. And what we want to achieve, just to wrap things up, transparency, access. This is one of those things, as I mentioned at the beginning, we formed C2, collaboration centric. Because of our relationship with C2, we were able to bring this to the Pacific Northwest. It's a unique option. Not everyone out there has access to captives, but there's a lot of proprietary programs underneath the hood. One of the unique ones that I listed there, it's Active Care. It's a diabetes program, and if you have any members that are diabetic, it's actually a pretty amazing technology where they actually get a glucometer that's a cellular device. So when they're testing, you can actually have that fed back to the results back to their doctor, the spouse. If it's a child that has glucose or they're a diabetic, you can actually see that the child is testing, and it can be fed to a parent's phone. So there's some amazing technology out there. There's also a call center to where it's scary, but if your glucose is running 40 or 50, so you drop down very low, you're this close to a diabetic coma, they will actually, if they can't get a hold of you and your emergency contact, they'll dispatch 911. So there's a lot of things we take for granted, but again, if you're a diabetic, this could be a very important tool, both for the member, but also for the family. So that's just one example of kind of a unique option that's out there. Again, because you are sharing risk in a captive, you want to have like-minded employers in that group. And then again, it's the long-term play. We're looking for rate stability over the long term, and that's really what going on a self-funded basis with a captive provides for you, because really you're paying for what you consume, but you still have that stop-loss protection that's giving you that upper-end protection for those large claims. So next steps, if you're interested in talking more about the captive, we'd recommend a deeper dive into the program. There is a qualification discussion, and this is an important thing to be aware of. Captives may sound great, and you say, that's exactly what I want to do. You may not be a candidate, because again, you have to qualify in order to get into the captive. Now again, it may be something that I'm not a candidate right now, but you may want to work towards that, and that would be the discussion that we'd have. If you do qualify, you would want to get a proposal. We'd go into the full details of the plan, and then you'd want to talk about an implementation timeline as well, syncing that up with your renewal. And like I said, about half of the groups that apply are not a candidate out of the gate. So it is something that is very selective, and if you're in that captive, you want it to be that way. You want to have as much good risk as you can going into that captive. But a couple options, if you're not a candidate out of the gate, you can improve your profile. You can start working towards improving that profile. There are standalone options out there as well. Like I said, LifeWise has a great bundled program that does some of the same things on a standalone basis. We also have a lot of groups that take the first step into self-funding with what's called a healthcare reimbursement account. And so basically what they do there is they raise their deductible, but again, they self-fund. Let's say you go from a $500 deductible up to a $2,000 deductible, and then they say, okay, if an employee hits from 501 to 2,000, the company is going to reimburse for that. And basically that is an actual self-funded plan as well. That starts to get you into some of the data. So there's a lot of options out there. Each group is unique. And so I think it's definitely worthwhile when you're looking at, okay, what are our options going forward? That may be something that you do want to consider. And so to wrap up, because I know I got 2 minutes left, Lisa, so thank you. Really, we wanted today just to introduce you or give you a high-level overview of 3 different topics. You know, the healthcare reform, I think the final regulations that Sarah went over, there's actually some very positives in these final regulations. They have at least eased into some of the regs. So it is, though, she went through it high level very quickly. There's a lot of details. Each group is unique. We recommend actually getting an analysis done with your benefit consultant, going through, making sure you know where you're going. Wellness, and I think the word is actually almost changing to more population health management. Some of the things that Elisa shared with you today, really getting into some measurable results, whether you're participation or outcome-based, actually seeing, are you moving the dial? Are you improving the health of your population? So that's a year-over-year analysis of the data, the biometrics that you showed on cholesterol and high blood pressure. You can actually see improvement in your members, and that's something you want to track. Again, the other thing I'll say about LifeWise is they've actually put, their money where the mouth is. So they say they believe in wellness. They've actually created a program that integrates the wellness that actually rewards an employer with rate stability, lower discounts, lower trend calculations on renewals if you're doing certain wellness practices and having those employees engaged. So it's a great, unique program. And then hopefully we introduced a little bit, it's an old concept, but with a new twist on defined contribution. And then captives, I think, is something that you're going to be continuing to hear more and more about. Overview only, each group is unique. So again, I'd encourage you, if you do have questions, definitely hit us one-on-one. And with that, I appreciate your time. Thank you again to LifeWise for sponsoring. I appreciate everyone taking the time. I am going to work with Reagan and Lisa to send out the video, because when you see the video, if you didn't get anything else from today, remember the video. It's called Conference Call. Some of you may have seen it, but it's hilarious, and I think you'll all relate to it. So we'll work on getting that out, and with that, I appreciate your time. Thank you.